What's up everybody, welcome back to my YouTube channel. My name is Javi, and in this video I want to talk to you guys about this crazy real estate market. Specifically, if we are in another potential bubble. In the last year, the real estate market has been booming, and it has been leaving a lot of people wondering if we are going to be seeing the same effects that we did in the 2009 market crash. Quick plug, if you guys like this video, please make sure to click that like button and subscribe for more. Alright, let's jump back into it. So before getting into my thoughts about the current real estate market, let's first talk about why the 2009 market crash even occurred. So traveling back 13 years ago when the 2009 market crash happened, this was a result of low interest rates and loose mortgage lending habits. Back then, almost anyone could get a home assuming you had a job. And even if you couldn't afford a home, banks were giving out loans to borrowers with very weird mortgage loans, and this allowed borrowers to temporarily afford a home. As a result, home values increased year over year, and finally when this bubble burst, many homeowners lost their homes and houses price decreased by 22% according to an article that I read by The Balance. This decrease in home values did not allow homeowners to sell their home and cover their outstanding loan. Additionally, when the federal government finally increased mortgage rates, this made home values too expensive to homeowners who bought a home at the moment because their interest rates went up and their mortgage rate was too expensive at that time. So with that said, the question many people are asking themselves are, will we be seeing a market crash in the upcoming months to a year? And personally, I believe that this is a no, and for 4 reasons. Okay, so the first reason why I don't think this is going to happen is because now we have higher lending standards. Before the crash, banks offered easy access to borrowers to get loans. Borrowers were allowed to qualify for a home with little to no documentation, and risky practices were taken, such as an optional ARM, adjustable rate mortgages. These rates were adjusted by the LIBOR rate, the funds rate, and the 1-year treasury bill. These form of loans are also known as a variable rate mortgage, and interest rates change depending on the term of your loan. This can be anywhere from a month to month to 5 years. This could mean that the home that you were one day able to afford then skyrockets and you are not able to afford that anymore. So during the 2008 crisis, the LIBOR rate increased, causing homes to become more expensive. This could be the difference between being able to afford your home, like I said, or not. And since the mortgage crisis, standards have been raised and the process to obtain a mortgage is much more rigorous. So borrowers must undergo income and asset checks before they get a loan. As a result, this has made getting a house a lot more robust, and this has made the market less prone to dips. And if the market does have a dip, it will be protected by the new regulations. Okay, now the second reason is the pandemic mortgage forbearance. So during the 2009 crisis, foreclosures accelerated the rate at which home values decreased. Since there were more homes in the market, homes dropped in the prices that were already seeing price drops due to unemployment. So this caused borrowers to be deeper in a negative equity. However, during this pandemic, the forbearance program allowed homeowners to temporarily postpone their mortgage payment without suffering any penalties, and instead of paying for their mortgage right now, they could add those months to the end of their 30-year or 15-year mortgage. As a result, homeowners who lost their job due to the pandemic were not in such a big concern about how to get all their payments in time and be at risk of losing their home. Additionally, for those homeowners who were not affected by this pandemic, they were still allowed to use this forbearance for their own benefits. This essentially gave them an opportunity to park their money into different assets that they would have not been able to because of their mortgage. So they could have used their money for different assets such as stocks, businesses, home renovations, or just buying more homes. And I think a combination of all these factors is why we saw such a big spike in stocks and homes, because just people had more money, or homeowners potentially had more money if they were not affected by this pandemic than they would have had money if the pandemic would have not happened. So now that that pandemic is starting to recover, we are seeing that borrowers are starting to get off of this mortgage forbearance and are starting to pay off their mortgage payments, which is good. So this has been in a steady decline month to month since the end of 2020, which is pretty good because we are seeing that the pandemic is starting to come to an end, and with vaccines coming out and rapidly being distributed to the whole economy, we are seeing that this is starting to decline. However, it's good to note that according to an Adam data, a 70% increase in foreclosure is expected to happen in the next 2 years. However, this is not something to worry about in my opinion, because back in the 2009 crisis, foreclosures were up to 6 million. Alright, so now the third thing is homeowners equity cushion. In 2020, the average family with a mortgage had an equity of $194,000. As a result of homes going up in the recent months, homeowners have gained approximately $26,000 in equity. In comparison to 2009, where homes actually lost value than what they had when they first bought their home. So this gives them a cushion to their home, so they will probably not have to foreclose with things going bad. And then finally, the fourth reason I don't think this is going to happen is because of price growth kind of slowing down, and we're not going to see such an exponential rate in prices going up. So during the pandemic, buyers took advantage of the record low interest rates that were below 3%, many of which were millennials. So this caused a shortage in home inventory, and as a result increased the median existing home price. So now my thoughts personally on this inflation is that it's going to continue going on for the next few months to years until we start seeing new homes being built. Now this could be a potential fix, or it could not result in anything if people continue to buy more and more homes. However, we don't know that until we see that happen, and we will know what happens when it happens. So I think that this is going to be a fix, but we'll just see. However, according to the National Association of Realtors, they forecast that the median price will rise between 3 to 8% in the next year. Now, when you compare that to 2020, that seems really, really low, but when you compare that to the 2009 crisis, that's actually a really good outcome. So with that said, I think if you are in the market for a home, then I think that buying a home right now is not going to be something to be worried about. I think the real estate market is in a safe place right now if everything just starts to slow down in the next few months to years. I think that this increase in home value has been a result of people moving away from cities into homes, because they can now work anywhere they want, with a lot of businesses working remote. So if you are in the market for a home, just buy one, because what seems temporarily expensive today may not seem expensive down the line. So with that said, I hope you guys liked this video and got some value out of it. If you did, please make sure to click that like button and subscribe. If you guys want me to make any video particularly, just leave that in the comments and I'll make sure to get to that. All right, I'll see you guys next week. Peace.